Welcome back to AOF Market Intelligence, powered by AI. You're tuning in because you're serious about real estate investment, right? Rental properties specifically.
Yeah, and you want to get past the headlines, cut through the noise. You want the real story.
Exactly. You want to understand the data, figure out what it actually means for your investment strategy, and maybe find out where the smart money's headed.
And today, we're really digging into something we hear a lot about. It's this question. Why does Edmonton, right now, look like it might be a more fertile ground for rental property investment compared to Ontario?
We've got a stack of reports here. Economic data, real estate figures, Alberta, Ontario, all fresh up to April 2025.
And our mission really is to pull out the key insights for you, give you that clear picture of Edmonton's potential advantages in the rental space.
Okay, let's unpack this. Where do we start? Maybe the big picture market trends. As an investor, that's probably job one. Where are things heading?
Makes sense. Let's look at Alberta first. The CREB economic region data, it's mostly Calgary, but it gives us context. So, April 2025, single-family detached sales, down year over year.
Okay.
But, and here's the interesting bit for investors, new listings were down even more.
Right, so tighter supply.
Exactly. Push the sales to new listings ratio up. It suggests a balanced market, maybe leaning a bit towards sellers. Now, hold on to this number. The benchmark price for detached in Calgary, almost $770,000.
$770, okay. Got it. Now, how does Edmonton look? Different story.
Yeah, a bit different. Edmonton and the area, total residential sales in April 25, they were down slightly, maybe 8% year over year.
Okay.
But new listings actually nudged up a tiny bit. So the sales to new listings ratio was just under 60%.
And the price, that's a big one.
The average price, total residential in Edmonton, was around $470,000. Now that's a big jump year over year, almost 12%.
470 average, compare that to Calgary's 770 benchmark for detached. Big difference already.
Huge difference. And here's something key for rental investors. Months of inventory, the MOI, for detached homes in Edmonton, about 1.4 months.
Wow, 1.4, that's low.
Very low.
Oh.
Signals a tight market, right? Demand is strong relative to supply. For you as a rental investor, that could mean finding tenants faster, maybe having more leverage on rents down the line because things are scarce.
Okay, so low inventory, strong demand signals in Edmonton. Now let's contrast that. What was happening over in Ontario?
Right. Let's look at Ontario. Think about the big markets. GTA, Ottawa, Hamilton, KW. April 2025 tells, a pretty different story there.
How?
Take the GTA. Sales across the board. Down significantly compared to the year before, but new listings, they actually rose.
Oh, opposite of Alberta then.
Oh.
More listings, fewer sales.
Exactly, which pushed that sales to new listings ratio down. And the killer point for your wallet, prices. Benchmark prices in the GTA are just way higher. Still, even with some softening year over year, single-family homes easily over what, $1.3 million?
$1.3 million versus Edmonton's average around 470. That's start.
That's the first major takeaway for a rental investor, isn't it? Your initial capital just stretches so much further in Edmonton. $470K average there versus, say, Ottawa, where single-family benchmarks are well over $800. GTA. Different planet.
Yeah, absolutely. That lower entry cost in Edmonton, it directly impacts your potential cash-on-cash return right out of the gate.
Totally.
It's almost, do you buy one place in, say, Hamilton or maybe two, nearly 3 properties in Edmonton for the same money?
It changes how you think about building a portfolio, diversification, all of that.
Okay, let's track those prices a bit. What have they done over the last year or so?
Both Calgary and Edmonton saw prices go up, but like we said, very different starting points. In Edmonton, over the year leading up to April 2025, the benchmark for a single-family home climbed from around $390,000 to over $430,000.
Okay, so decent appreciation.
Decent appreciation, yeah, but starting from a much, much lower base than Ontario. That combo, lower entry costs, plus that upward trend, looks pretty appealing for long-term value.
Okay, so Edmonton wins on entry cost. Big check mark there. But what about market speed? You mentioned months of inventory, MOI, and the sales to new listings ratio, SNLR. Can you unpack those a bit more? What do they tell an investor trying to actually buy something?
Sure. So months of inventory, MOI, basically tells you how long it would take to sell everything currently listed if sales continue at the current pace. Lower MOI usually means a seller's market, things move fast. Higher MOI favors buyers, gives you more breathing room, maybe more negotiating power.
Got it. And Edmonton was low, you said?
Yeah, really low in April 25. Detached homes around 1.4 months, apartments around 2.0, townhouses super tight at about 1.0 month. Those are competitive numbers. Things are moving.
And how did Ontario stack up on MOI?
Generally much higher. In Ontario, for similar property types in April 25, Ottawa, single-family MOI was like 4.6 months. Hamilton, about 2.5. Kitchener-Waterloo, 2.4. London and St. Thomas was way up there, around 6.4 months.
Whoa, 6.4 in London. That's a big difference from Edmonton's 1.4 for detached.
Huge difference. So those higher MOI numbers in Ontario suggest more balanced markets, maybe even leaning towards buyers in some spots like London.
So, okay, translating that for the investor. In Ontario, you might have more choice, maybe haggle a bit more on price. But the flip side could be slower appreciation potential. Maybe even finding tenants takes longer compared to a tight market like Edmonton.
That's a reasonable inference, yeah. The quicker pace in Edmonton suggests stronger underlying demand. And like we said, that could translate to more consistent rental income and maybe better potential for rent growth over time.
Makes sense. Okay, let's shift gears slightly. What about the economic fundamentals? What's the backdrop in each province look like?
Good question. Alberta's economy, looking at data around April 2025, looked pretty healthy. Solid GDP growth. Retail trade was up strongly year over year. Employment numbers looked good. Unemployment rate was relatively low.
And anything specific impacting housing?
Yeah, the big one. Net interprovincial migration. People were still moving into Alberta and in significant numbers. That directly fuels housing demand, both for buying and, crucially for our listeners, for renting. More people means a bigger pool of potential tenants.
Right, drives demand. Okay, what about Ontario's economy?
Ontario's economy also growing in parts, but maybe a different overall feel. GDP growth was there, but maybe not quite as robust as Alberta in some forecasts. Retail sales up, but employment growth seemed a bit more modest. Unemployment generally a touch higher than Alberta's.
And migration.
That's the key contrast, really. Ontario was seeing net out migration provincially, more people leaving Ontario for other provinces, including Alberta, than moving in from elsewhere in Canada.
So people moving out of Ontario into Alberta. That's a pretty powerful long-term indicator for housing demand, isn't it?
It really is. It shapes demand dynamics quite significantly over time.
Okay, so let's try and tie this all together for someone thinking about where to put their rental investment money. What's the bottom line here?
The picture emerging seems pretty consistent, right? Edmonton offers that significantly lower price point to get in the game. Your dollar buys more property, basically.
Yeah, affordability is key.
Then you have the market indicators, like the low MOI in Edmonton, suggesting pretty strong demand, which could be good for filling vacancies and potentially pushing rents. And underpinning it all are those economic factors, especially the positive net migration into Alberta, suggesting continued demand for housing, rentals included, in places like Edmonton.
So even though we don't have the specific rental rate data in these reports.
Exactly, we can infer. Lower purchase prices in Edmonton create a better foundation for potential cash flow, even if rents were, say, similar to some Ontario spots. And that tight inventory we talked about, it points towards a healthy rental market, likely with good occupancy rates.
So summing up the key insights from this deep dive, if you're a rental investor prioritizing maybe lower initial cost, entering an active competitive market, and seeing positive economic tailwinds like population growth, Edmonton seems to present a more compelling case right now compared to many Ontario markets.
Yeah, in Ontario, you're often dealing with much higher prices, and the market dynamics, the inventory levels, they're just different, which naturally impacts potential returns.
Okay, that wraps up this deep dive comparing the rental investment landscapes of Edmonton and Ontario. Thanks for joining us.
Yeah, thanks for tuning in.
This has been AOF Market Intelligence, powered by AI.